Good morning from London. I'm Anna Edwards alongside Lizzy Burden. We're an hour away from the opening trade. Here's what you need to know. US and European futures are higher ahead of a busy week for central banks with rate decisions expected from the BOE, ECB and BOJ. Data watchers will also get a preliminary look at key global PMIs, labour data and inflation prints. Plus, President Zelensky suggests Ukraine could drop its bid for NATO membership in return for Western security guarantees. He's set to meet European leaders today for a major summit.
Well, happy Monday, Anna. Checking in on these markets, and it is the last full trading week of the year for 2025. Of course, last week ended with that sell-off on Wall Street, prompted by all of the worries about AI. But we've got futures pointing higher on both sides of the Atlantic this morning. As you say, a big week for central banks, the BOJ, the ECB and the BOE in focus. We've got euro dollar pretty steady right now at a 117 handle. The countdown to the opening trade starts right now.
Welcome to the programme, everybody. This is the opening trade. It is Monday, the 15th of December. Lizzy and Anna with you this morning. And Lizzy, we said in our headlines that this is going to be a really busy week, and it is. It isn't the end of 2025 yet. We still have some impactful data and central bank decisions to come. Why don't you start by taking us through the agenda ahead of us?
Yeah, what's on the docket? So tomorrow we're going to get US non-farm payrolls. Of course, we've been starved of eco data out of the US because of the government shutdown. Then we get CPI from the UK on Wednesday. Thursday, we have a double bill for central banks, the ECB and the BOE deciding, and we get US CPI, so partial numbers for October, full numbers for November, and then Friday we end the week with the BOJ. So should we start with the central banks?
Yeah, let's start with the central banks. I think it's interesting because from a Western economy central banking decision, the conversation over the last week, maybe even 2 weeks, but certainly the last week, has turned more hawkish. So even if this week we're going to get, certainly from the Bank of England, the expectation is a rate cut, and that might sound dovish. Actually, a lot of the most marginal movement in thinking over the last 7 days or so has been, where's the hawkishness coming from? Certainly the ECB. We might see some of that expressed in some of the commentary from the Bank of England, and of course there's the BOJ.
Yeah, I wonder whether we're overweighting the comments from Isabel Schnabel at the ECB, given we already knew that she was a hawk. When it comes, though, to the Bank of England, as you say, the expectation is that it's a cut. We've got the budget to factor in this time. It could be a really tight split. 5-4 is the vote split that's expected. It could be the Bank of England Governor Andrew Bailey again who is deciding. But we have the data coming. As I say, we've got CPI coming. I wonder if there is a CPI print that could stop the BOE from cutting this week.
That is interesting, isn't it? The fact that we get data and then decision. So we'll certainly keep that in mind. The BOJ also in focus, though, at the end of the week, expecting to get a hike there. We got the Tankan survey, which, of course, is confidence amongst big businesses over in Japan. And actually, that came in at a 4-year high. So certainly if you're looking for reasons for the BOJ not to move as expected, not to hike, then you didn't find it in the Tankan. So it seems as if the market expectation for a hike is intact.
Yeah, and we get Japanese CPI on Thursday, so that's expected to show inflation sticky. Again, that would back the case for a hike. But let's talk about the other data that we've got on the docket, because of course we've already had the Fed decision. Now the focus turns to the US data that's coming. You've got to ask how much clarity it's really going to give when it comes to the Fed cuts that are ahead, or really when they're going to end. Our economists at Bloomberg Economics, led by Anna Wong, say actually there's not going to be much clarity out of this. And already you've had Jay Powell kind of making excuses for the data, saying that technically it could be pretty hairy.
Yeah, absolutely. Many reasons why the data might be sidelined or ignored, or people will tell whatever story they want to tell on the back of the data.
So far, right?
As they often do. But we'll get that November data. This is the jobs data, of course. We'll also get an estimate of October data, but there'll be so many sort of bits of the data missing that might be difficult to interpret. On the November CPI, that could be undermined because of a lack of some of the data collection that usually goes on there. So, yes, to your point, will it really give us any clues as to whether the market is right and we get 2 cuts from the Fed in 2026, or whether the Fed dots are more accurate and we get 1 dot? I mean, we won't have the answer until this time next year. But this is where the market's thinking is, even if the most recent direction of travel in the Fed narrative has been a little bit more hawkish, thinking about when do we get that turn? When does the Fed stop cutting interest rates, even though we're waiting for a new Fed chair?
And, of course, that is crucial for the bond market. We've already had the Chinese Chinese retail sales data this morning, dropping about 2 a.m. London time. So factory output not that weak, but retail sales the worst ever outside of COVID. And so it's a lopsided economy in China right now. The question then turns, how much is the government going to stimulate? And you've had Xi talking about he only wants real growth. Don't do anything that's only going to superficially help growth. So now we have to wonder, if the 5% growth target is safe for 2025, how challenging will it be in 2026 unless they put up enough stimulus?
Yes, indeed. How challenging will it be in 2026, especially when you get those kind of comments from Xi talking about how, yes, it's not just about hitting a number. We shouldn't be evaluating everybody on whether they deliver X, Y, Z on growth. It should be about a more holistic look at the economy. What does that mean for the market's expectations of more stimulus to come? And in terms of US and Western expectations about rebalancing in the Chinese economy, well, this tells a pretty dire story about retail sales, doesn't it? It tells a story of an economy that is built for exports still, and we've seen that happening over the Chinese export story recently. Sure, they're not going to the States as much as they were, but they're finding homes in the rest of Asia and in Europe. So that's an ongoing political part of this China economy story.
But indeed, we've already seen a bit of a market impact this morning. So you've seen the government saying that it's planning more financial support for consumption. That's boosted some of the Chinese retailers. And you've seen iron ore sliding towards $100 a tonne this morning. Keep an eye on the China-exposed European stocks.
Let's talk about Ukraine, because the meetings continued over the weekend and further meetings expected, a significant meeting expected today. So President Zelensky now seems to be suggesting that Ukraine could be willing to abandon an ambition to join NATO if the US and EU security guarantees that come with any peace deal are sufficient. So that seems to be the most recent talking point. What do the Russians make of the latest plans that have, 5 hours spent behind closed doors for the US and Europe and Ukraine to talk about this yesterday? Not to mention, Russia's not in the mix there. So this still doesn't have full approval of anybody. This still is not all of the parties in the room together. A little bit more information from Italy on where they're sitting, and their commitment to Ukraine remains intact, it seems. But we do have this big meeting taking place today, bringing in more European voices. So around 10 European leaders, Mark Rutte, Ursula von der Leyen, meeting with Zelensky.
Yeah, and you'll have UK Prime Minister Keir Starmer, who notably also has another thing in the diary today. At 2 p.m, he's got the liaison committee, so I wonder how he'll fit the two together. But it reflects, doesn't it, a piece that Alex Wickham, our UK political editor, wrote over the weekend, this pull between international and domestic forces for Keir Starmer. He seems to be doing quite well on the international stage, but domestically, real difficult issues. But yeah, it's a key week for Europe, given that Trump has said that Europe's so weak. It's got to show how it's going to move forward in terms of funding Ukraine's fight against Russia, the question of frozen Russian assets and whether they can all agree on what to do with that, but also the question of trade and that South American trade deal with Mercosur, a huge thing to get done this week. Can they diversify trade away from the US? If they can, big deal, and it'll be a clear signal to Trump.
Yeah, absolutely. More details on that, and certainly we will be focusing in on the frozen Russian asset story as we go through the week, because there's lots of politics to talk about there. Let's tell you what else is coming up in the programme in terms of the guest conversations we're going to be having. Sri Kochagovindan will be with us, Aberdeen senior research economist, really helping us to set up the data and the central bank decisions that still lie ahead for 2025. Phoenix Kalin will be with us, Societe Generale global head of emerging markets research. To some extent, the story of 2025 has been, what the dollar's lost, emerging markets to some degree have gained. So we'll talk about that. John Bilton, JP Morgan global multi-asset strategy head. What are his latest thoughts on opportunities in Europe? And Ben Barringer will be with us, Quilter Cheviot, global head of technology research and investment strategist. We are going to be specifically talking there about the media landscape in the United States, those bids for Warner Brothers. Lizzy, certainly in focus.
Here's what else you need to know this morning. Well, Australia is considering tougher gun laws after 15 people were killed in a terror attack on Bondi Beach. One of the gunmen was also killed. A father and son have been identified as the attackers who targeted members of the Jewish community as they celebrated the start of Hanukkah on Sunday evening. It's the worst terrorist attack in Australia's history. A bystander who tackled one of the gunmen has been praised by leaders, including President Trump. He's been named by local media as Ahmed Al-Ahmed, a 43-year-old father of two. Elsewhere, France is seeking to delay this week's EU vote on a free trade agreement with South America. The proposed accord with Mercosur has been 25 years in the making, but the French Prime Minister Sébastien Lecornu says that measures to protect EU farmers and consumers are insufficient. Sources say that the deal could collapse if it isn't signed by the end of the year. And former Hong Kong media mogul Jimmy Lai has been found guilty of endangering national security in a landmark trial. The city's High Court convicted Lai on 2 counts of conspiring to collude with foreign forces, a crime punishable by life in prison under the China-imposed national security law. Lai was also found guilty of conspiring to publish seditious materials. A mitigation hearing is scheduled for January 12th. According to his lawyer, Lai has yet to decide on whether to appeal the verdict.
Coming up on the programme then, the EU is discussing ways to soften rules that would have banned new combustion engine vehicles by 2035. We'll see how automaker stocks react to that latest news flow at the market open. Plus, the UK is set for a barrage of data and an all-important Bank of England rate decision. We'll get a preview of the data and the decision that's still ahead here in the UK. Up next, the ECB and BOJ also in focus with policy decisions this week. We'll preview the week's market action. If you have any comments, if you want to get involved in any of the conversations around this desk, IB plus BBTV Go is the function to use on the Bloomberg terminal. This is Bloomberg. Welcome back to the opening trade. 7:14 here in London. European equity market futures, after the wobbles in global equities on Friday, we are looking for a little bit of a gain this morning, up by around 0.4%. And Lizzy, we've got E-minis up by 0.2%, trying to recover a little, but certainly not all of the lost ground from Friday.
Yeah, well, if we look at the Treasury picture, pretty steady there as well, down 2 basis points on the 10-year. But look, the front runner to become the next Fed chair has said that he would consider President Trump's policy opinions if he were picked, but that the Fed's interest rate decisions would still remain independent. That's Kevin Hassett, of course, and he was speaking after the US president said that he should be able to make recommendations on rates set by the Fed.
I think he has very strong and well-founded views about what we ought to do. But in the end, the job of the Fed is to be independent and to work with the group of people that are on the Board of Governors at the FOMC to drive a group consensus on where interest rates should be, and to do so, basically with the guidance of the Fed chair. But in the end, it's a committee that votes.
So Kevin Hassett speaking there. Let's bring in Bloomberg's Valerie Teitel for more, because Val, I went on holiday 2 weeks ago and it seemed pretty obvious who the front runner was, but now there's another horse in the race.
Yeah, we had the Wall Street Journal reporting that it's actually both Kevin Hassett and Kevin Warsh who made the final round of interviews that supposedly took place at the White House last week. Trump still teasing that he is going to make this pick in the near future. The markets think that that's probably going to be sometime next year. But it's interesting that all of a sudden we have Kevin Warsh back on the agenda. And we've seen this reflected in the betting markets. Poly market odds for Kevin Hassett 2 weeks ago were at 85%. It's now dropped all the way down to 50-50, and Kevin Warsh has risen in the odds to take that place. Now, speculation on why this shift happened. Maybe there was some pushback from Republican leaders in the Senate, from market participants on just how close Kevin Hassett is to the Trump administration. He's essentially the #1 economic advisor, wrote a lot of the economic plans for the Trump administration. Perhaps that link to the White House is just too close for comfort, and perhaps another reason why they are considering Kevin Hassett as a contender as well. Now, note the differences between these two. It really stands out on what they've guided as their opinion of quantitative easing. Kevin Warsh is actually a big someone who's very critical of quantitative easing and the Fed's use of their balance sheet, which is kind of a hawkish thing, but does agree with what Treasury Secretary Scott Bessent has been criticizing the Fed of late.
Okay, that's interesting. At least we're pretty sure that the person is going to be called Kevin.
Yeah, Kevin.
Pretty much what we can say right now. Let's go into some of the details that lie ahead of the week ahead, then, Valerie. Where do you want to start?
Look, I do think that non-farm payrolls is probably going to be the most interesting thing, because there's elements of this payroll report we do get some flavor of October. October. Yes, we don't get the unemployment rate for October, but again, it's essentially a double data print. And we know that the labor market is still under keen focus for the Fed. If they really were going to shift frame and guide for a cut early next year, it would be because we got some more substantial weakening within the labor market. We also get retail sales out tomorrow at the same time. So it's going to be a very busy session on Tuesday, headed into a very heavy central bank week at the end of the week. You know, we've gotten even more hawkish hints from the Bank of Japan overnight. They've been teasing that they might start their ETF selling of their ETF portfolio as early as January, and this comes after they've guided previously that they might not just hike on Friday, they might also guide for more hikes next year. Same with the ECB, a bit of a hawkish shift last week, so some hawkish hints at the end of the week to brace ourselves for.
Okay, we will look ahead to that then through this week. Valerie, thank you very much. Been based Valerie Titel, of course, with the latest on what we're expecting to get from US data and all the central banks that are meeting this week. Joining us now to discuss is Sri Kochagovindan, Senior Research Economist at Aberdeen Investments. The perfect voice to have with us in a busy week. Sri, thank you very much for your time this morning. So Valerie's taken us through some of the data. Let's start with the US. We get some data out of the US this week. What's at stake for you? Do you think the data we're going to get is going to really shape people's expectations about 2026, or do you think actually with the personnel changes, the imperfections in the data, that's too high a bar?
I think so. I think there's still a lot of uncertainties, as we've just heard from Valerie, that we get some of the data, not all of it, in terms of NFP. So there's a lot of data that's going to be missing, not just in the labour market, but also in inflation. It's very difficult to sort of interpolate across the days that you can actually collect the data. So that's one side, which is, I think, pretty much expected in the market. So there's unlikely to be big surprises there that will be persistent. But really, it's a case of looking to next year. I think it's very much a given that what we saw last week was the very last hike, cut from Fed Chair Powell, and now we're expecting, which a lot of different economists are, that the next cut will be in the second half of next year under the guidance of the new chair. So, yes, there will be some question marks about Fed independence, but I think overall it's very difficult to sort of shift away from the framework that we have. So we're quite confident in the independence story. But I think there might be times when the market will be volatile in response to some of the commentary and who is actually chosen. So I think it's still important.
Yes, and I think it's interesting the point Valerie made actually about quantitative easing and whether that's actually something. Because I wonder whether it tells us, the Fed chair might not tell us exactly where rates are going to go each time, but maybe the Fed chair tells us something about the willingness of a Federal Reserve to use unconventional monetary policy, if we still think of QE as unconventional. But is that where the relevance of this decision lies, do you think?
I think that's part of the story, but I think the more interesting sort of cues that we're going to be looking for is, do they really meaningfully deviate from the data and the framework? Are they, and what we heard from Kevin Hassett, it was a reassurance that we will be monitoring the data. We will not be moving away from that sort of path of their mandate. So I think anything that sort of deviates from that, which I think is unlikely, I think that will be a worry for the markets. So anything that can be misinterpreted, I think, wording will be very important going forward.
I want to take us from the Fed to the BOE because, as we say, expect it to be a close call, expect it to be a cut. Will it be a hawkish cut?
I think so. I think there's a mix of data. Obviously, the GDP data, activity data was a bit weaker. But then if you look under the hood, there was some nuances there. It was more the volatile components. There was the cyber attack on Jaguar Land Rover. So if you take some of that out, maybe it wasn't as weak as you would expect, but you are expecting a weaker Q4 GDP.
Do you expect a quarterly contraction?
Not a contraction, no, but a flat, I think, in the quarter. It's very hard to sort of come back from this contraction and make up some of that loss to make a meaningfully positive GDP number. But then you also have the stickiness in inflation. It is moving in the correct direction, but it's still quite sticky. So it affects the pace at which you can ease from here. So,
Is there a CPI print this week that could stop the BOE from cutting?
I think if it was meaningfully stronger, but it would have to be, I think it's unlikely, actually. I think they're going to be looking at that overall trend. Wages have been weakening. I think they still have this sticky core services, but they expect that to move lower at a slower pace. I think it's going to be very difficult. It is a very close call. It is a very close call. Yeah. But I think there are a lot of moving parts that would support a Bank of England cut. And I think that last week's GDP print is one of them. But it's still not enough to sort of say, OK, we have to speed up our pace of easing. So it is a close call. But we do think that Governor Bailey is likely to switch. Yes. And make it that 5-4.
So from 4-5 to 5-4, and then go for the cut. So let's move on to the ECB then. Yes. And you were making the valid point, Lizzy, and one that we were talking about last week, but it didn't seem to have much of an impact on expectations in the market. We had Isabel Schnabel making hawkish comments about whether the next move would be a hike from the ECB, and immediately everyone says, well, she's really hawkish, so should we be surprised? But the market did reprice a little bit on the back of it. So why pay so much attention to those kind of comments?
It was interesting. Clients just the week before were very sceptical when I was talking about the potential for a rate hike in 2027, which is our view, and the rationale behind that view is that eventually you do get some support to activity from fiscal stimulus, mainly Germany, but that filters through over time. But it's not an imminent hike. And it was interesting that there was a lot of scepticism about that, and then suddenly there's a repricing. So again, it's that shift in sentiment is going to be really important across these different markets. A slight wording change, and I think that would apply to the other central banks, the new Fed chair, and that's what we've kind of seen in the last week in that response to Schnabel. I think she just I don't think she really gave a clear signal in terms of timing, so I'm surprised that there's so much priced in for 2026 even. So I think that would possibly be a bit too soon, but yes, an eventual hike, but on hold for now is very much, and I think we're going to hear that reiterated from Madame Lagarde on Thursday.
I also just want to ask you about the BOJ, because you've got a hike fully priced. We had more data, as we were discussing this morning, Tankan.
Yeah.
Are investors more concerned, though, with fiscal policy?
Yes. Absolutely. I think the bond markets are really going to be focusing on the news flow beyond the Bank of Japan. So I don't think we're going to see any big surprises on Friday when they hike. Yes, it is a 30-year high, but I think the real focus is immediately going to shift in terms of the following week. I think it's around Christmas that we get more announcements in terms of fiscal year 2026. So they've had a supplementary budget. It was bigger than expected, but the issuance plans around that from the Ministry of Finance were not too drastic. And I think that's what everyone's going to be watching. How is this all going to be funded? Because you need more military spending now, given all the tensions with China. Yeah. Which we do expect to sort of ease off next year. But at the moment, it's still a big red flag and warning in terms of both Japan and Korea have to step up their military spending. But also Takaichi has flagged strategic investments in AI, quantum computing, and really looking at a long-term plan. So I guess it will be the timing of these policies and then the issuance that's going to really move the market. So I think the Bank of Japan is very much priced in. But into year-end next, it will be the fiscal story. Yes. And I think you could see some volatility because you've got market liquidity is very thin. So I think you could see some volatility into year-end.
And I seem to remember the BOJ keeping me busy in December's gone past.
Oh, yes.
Yes. What is that, Sri? Why does it get so busy? But let me ask you then more on the BOJ. So the fiscal side of things clearly very important to it all. But how many hikes do you think the BOJ has in them?
I think, to be honest, I don't think it's going to be a very rapid pace of hikes from here. Couple of things in terms of they've had this focus on wage growth. Even in the recent speeches, they were talking about the next spring wage negotiations. Yeah. I think it's broadly expected that's going to be weaker than last year. And that's partly because of the tariff story and also the China trade story now. There's a bit of a tension there. Corporates actually managed... so automakers, for example, they slashed their prices in order to maintain their market share with the US. That's not sustainable, and I think that actually squeezes margins and makes it harder to pass on that wage growth.
All right. Well, Sri, it's great to see you. Sri Kochagovindan, always a pleasure, senior research economist over at Aberdeen Investments. And indeed, we'll continue this conversation on China next. China reporting the slowest ever retail sales growth outside the pandemic. We'll get you the latest on the data next. This is Bloomberg.
Welcome back to the programme, everybody. 7:30 here in London, so 30 minutes until we get equity market cash trading. With that in mind, let's have a look at the futures picture. And actually looks pretty buoyant this morning, up by 0.4% or so, maybe 0.3% for Euro Stoxx 50, trying to turn a corner, it would seem, from the losses of Friday. We were down around 0.5% in Europe on Friday. Worse losses in the States as the focus, the epicentre of the worry seemed to be around AI. So the Nasdaq by the end of the day was down by 1.7% and the S&P down by 1%. US futures, with all of that in mind, looking a little more buoyant, but not looking to claw back all of the losses of Friday, maybe just some of them. Let's have a quick look at bond markets. Of course, many central bank decisions from the ECB, from the Bank of England, from the BOJ, all of that, no doubt, finding its way into the global narrative. Last week, we saw a little bit of hawkishness added into that global central banking narrative, and that was pushing yields up in some places. But this week, we will wait to see what we hear from the great and the good of central banking. Lizzy?
Well, we've already seen weakness in the Asian session, Anna. New data showing that China's retail sales grew at the weakest pace since the pandemic, while investment slumped further, underlining the growing risks to the economy after several months of deterioration. President Xi reacted by vowing to crack down on what he called reckless projects that have no purpose. We can get more info now with Bloomberg's Alan Wan in Shanghai. Alan, in terms of the data, let's start there. What do these numbers tell us about the Chinese economy?
The Chinese economy is facing a lot of headwinds. I mean, there's nothing else to say except that was very disappointing. You already mentioned retail sales growing at the worst pace ever outside the pandemic, fixed asset investment shrinking 2.6% for the first 11 months of the year. You had industrial output missing estimates, and home prices extended their slump. I think you can explain a little bit of the slowdown in consumer spending, retail sales, by saying that, okay, we had the end of the trade-in subsidies, and you could say that local government finances are very tight right now to explain the fixed asset investment, but nevertheless, you can't explain it all just on that alone. And I think what's most troubling is the fact that the government wants to make domestic consumption a key pillar of the economy, and what do we see today? The retail sales slowing in the worst pace ever outside the pandemic. You see home sales continuing to fall. So the government has a lot of work to do ahead of it. I mean, the only upshot to all this is maybe it'll force the government to boost fiscal and monetary spending, including for the property market in particular, mortgage subsidies and tax breaks.
OK, well, that's interesting, Alan, because there has been, yes, expectation on and off about more stimulus to come from the Chinese government. But I wonder how we factor into that the comments we got from President Xi, who's been talking about cracking down on what he calls reckless projects. I mean, maybe a sense then that, you know, it's not only GDP that matters to him. And so what does that tell us about the willingness to do and provide further stimulus?
Yeah, I was kind of surprised just because, Xi Jinping has in the past talked about improving the quality of GDP growth. And today we sort of got a better idea of what he means. In the past, government officials have been promoted based on the ability sometimes to juice up GDP growth by, building exhibition centers they don't need, faking stats, faking construction launches and all that. Instead, Xi Jinping said that instead of doing that, he wants more positive examples like improving the quality of air and other things that will improve the livelihood of ordinary citizens. I mean, so he's changing the way government officials are being evaluated. So these metrics are changing quite rapidly, which is quite unique given the fact that in the past it's always been about growth at all costs.
Yeah, really interesting. Alan, thank you very much. Bloomberg's Alan Wan in Shanghai. Let's pick up on this theme and discuss it further then. Phoenix Kalan joins us, Global Head of Emerging Markets Research at Societe Generale. Phoenix, so nice to speak to you. Thank you very much for coming in as we get towards the end of 2025. I want to start by talking about China, such a big part of all emerging market baskets, of course. So what do you make of these comments from President Xi about quality growth? It's a theme he's talked about before, but in the context of people wanting more to be done to rebalance the Chinese economy, retail sales looking weak today, what do we learn about where the Chinese growth narrative goes next?
So I think it's about reprioritizing what their goals are, and it's shifting from short-term growth to really long-term perspectives about trying to smooth out imbalances in the economy, trying to grow growth sustainably, improving air quality, renewable energy, all of these priorities that are much more structural and long-term in nature. I think that's his emphasis. He's talking about like the cross cycle in terms of looking through kind of short-term growth dynamics, but aimed at more long-term implications about what can help sustainability in China in terms of the growth. So I think that's one area that I drew away from. Another is actually because there's been so limited impact on consumption in causing that to become a key engine and driver of China's economy. Actually, we realize how important the export channel is. That's still the primary engine of growth for China. And in that sense, that has so many implications on the currency in terms of that, we've seen fixing stronger across the past couple of weeks, but that's not sustainable. They can't have a strengthening currency that's going into kind of this deceleration that they are not able to get a hold of. So we expect for China's currency to stay quite stable, not to strengthen much from here. So perhaps just 1% more downside, but for most of next year, for dollar CNY to trade between a range of 7.0 and 7.1, so very stable.
Yes.
And projecting that kind of image of stability, but also relying on that engine as a key source of strength.
Yes, and even if the exports to the United States have been challenged, China's been able to find export markets in other parts of Asia and into Europe. But now the US and Europe all calling on China to pivot its economy, to try and diversify the economy, a little less around exports and a little more around domestic consumption. What is going to be the big theme in China then in 2026, do you think?
I think it's very difficult for them to shift away from the current strategy, which is still very slow around targeted stimulus measures. So it's still going to be that. They're still kind of parceling out fiscal accommodation to various parts of the vulnerable economy, doing a bit of monetary accommodation as well. So we think there's still going to be a bit of an incremental approach, and it's not going to be big bang type of bazookas that the market might want to juice up growth. So I think we're still not going to get those things that the market might expect or want.
Phoenix, you take us to the market impact, and it's been a great year more broadly for EM. You've got some big investors saying that 2026 could continue to be a good year for carry trades. Do they have further to run? Do you agree with that?
So to some extent, yes. So we've had about an 8% gain against the dollar for the median currency performance in emerging markets this year. So that's very robust. We've had kind of over a decade of really poor returns on average across EM currencies. Next year, we expect for that to only be about 3% versus the dollar. So substantially slower performance. That's because valuations are much more expensive now. The carry buffers have compressed in a lot of economies in terms of policy rates being brought down, inflation expectations coming down as well. So that really compresses the amount of earning that you can get from those rate differentials. And then on the other side, we think volatility is going to rise. So that's been quite low. That's been collapsed through the second half of this year across many asset classes, not just currencies. But yes, for next year, we would expect for there to be catalysts that cause volatility to pick up. And so in that sense, the carry trades will be less appealing incrementally. So we still like some of them in the high-yielding space, in LATAM, in frontiers. But for a lot of them, actually, we've switched out of being using dollar as the funding leg and into the euro as the funding leg.
Yes.
Especially all the LATAM currencies.
It's very interesting you say, Phoenix, that the volatility has collapsed because the whole year has felt extremely volatile.
Yeah.
But sometimes, that's the truth in the data.
Yeah, I mean, one for Mark Cudmore, that. But surely you could see volatility coming in for EM from the other side, from the DM side, if we've been talking about the Fed chair drama, we've been talking about the midterms over the weeks.
Yes.
Surely that could actually re-inject some volatility.
Yes, that's what I've been saying as well. I do think the midterm elections and in terms of the Fed chair volatility, the headlines that it could generate, what kind of policies might be expected in terms of the guidance that the new Fed chair might have on the rest of the committee, that could generate some volatility. But a small amount, because what we're talking about essentially is, whether the Fed cuts 25 basis points or 50 basis points next year. So it's still a relatively small range. So I think what markets are focused on is, despite kind of the nuance is still a relatively small range in the rate side of things. Equities, that's a different picture, and that's a much more volatile component.
Yes, and just sticking with FX, you do say quite specifically that in your notes the dollar is going to move towards a stronger dollar in 2026. Yeah. How much stronger, though, Phoenix? Because that will have a big impact on EM. Are we just talking about a small rebound, a small bounce, or are we unwinding all of the weakness we saw in the first half of this year?
And when?
So we think right now, kind of over the course of the next couple of months, we'll see a last dip lower in the dollar, coming out of the weakness that we're seeing in some of the U.S. economic data, labor markets, sentiment indices, and so on. And that will cause the dollar to come down to maybe 96.5 type levels by first quarter of next year. And then we expect for it to rebound back toward 100 or slightly above. So we're talking about a range of maybe 4%, 3 to 4%. So it's not huge in the context of things, but actually for the dollar, it's quite a lot if we have these moves.
OK, so the dollar bouncing back a bit next year. We also have to talk about the theme that kind of comes across all of our conversations, but that is the AI bubble and when it's going to burst. Everyone looking for value elsewhere, or is it just going to deflate? But do we look to EM? And if we do look to EM, where are the opportunities? So I'm talking about India. Yes. I mean, so many investments pouring into India, especially from Microsoft, from Amazon as well. So that's been a huge place that has benefited from the building of various AI-type data centers and innovation. So I think, yes, India, Brazil as well. Kenya is another place where they have really strong programs targeted at trying to capitalize on developing AI for the national strategies. But yes, I think every emerging market, or most emerging markets, have been forming these types of strategies about how to take advantage of AI, and especially to focus on the local economies, prioritize local languages, move away from the dominance that the DMs have with respect to controlling all those infrastructure and systems. And so it's so much about kind of the strategic diversification into AI that's going to enable this certain extent of resilience in emerging market economies over the future.
OK, so that's one thing we're watching in emerging markets. Something else, reform-driven developments. Where in emerging markets are you seeing reforms that maybe go under the radar, not getting enough attention from global investors?
Well, I think investors actually have been giving them a lot of attention, especially in the frontier markets. We have seen so much flows going into Egypt, into Nigeria as well. Those have been the most popular markets in frontiers this past year, and hence the strong outperformance from there. We expect for that to continue, and alongside other places like Kenya, for instance. So those are still places that are seeing fiscal consolidation, improved transparency around their governance and regulatory frameworks, more market-oriented kind of exchange rate dynamics, more free-floating regimes. So incremental gains toward a more market-oriented economy. So yes, I think those things are still happening, and investors are actually quite on top of it in terms of monitoring this. And the challenge now is really around kind of valuations. Do they warrant further investment? And in our case, we do think that for a lot of those frontier markets, Egypt, Nigeria, Ghana, Kenya, those are a strong place for further gains, especially from fixed income and the currency side as well.
Phoenix, can I ask you, one of our top stories this morning, and actually has been for many days, is ongoing conversations trying to bring peace to Ukraine. Clearly, this is going to have an impact on other neighbouring countries in Eastern Europe. What kind of peace dividend, if we do get to that point, what kind of peace dividend do you expect to see for those economies? Where should we be watching? Or will it be short-lived, depending on what the nature of the deal is?
Yeah, it is actually quite difficult to see how sustainable that kind of framework can be, because the security guarantees have not really been very strong enough for Ukraine to be satisfied with proceeding forward. So it's quite tricky, and especially if there's no strong U.S. support. And then in terms of on-the-ground boots, are there going to be elements of NATO? Are there going to be elements of UK and French troops there? So there's still so many questions that I think it's likely one in which the peace dividend is going to be quite short-lived, because there will be so many question marks about the sustainability of Ukraine as a sovereignty. Is there going to be a migration crisis into Europe from the Ukrainians once the borders are open? So I think that might actually undermine the euro and undermine confidence in kind of the sustainability of the security frameworks in Europe.
OK, really interesting. Well, hopefully we'll get a bit more clarity this week from the meetings happening in Europe. But Phoenix, great to see you as always. Phoenix Kalan, Global Head of Emerging Markets Research over at Societe Generale. Coming up, the European Union, as we say, is looking to soften rules that would have banned new combustion engine vehicles from 2035. That and other stocks to watch next. This is Bloomberg.
be picking a new head of the Fed soon. Our Fed person is absolutely, despite him, we have numbers that really nobody's ever seen, Vince, right? Despite him, we have numbers that nobody's ever seen before. We're fighting through him, and we'll soon have a good head of the Fed who's going to want to see interest rates go down. But we're fighting through higher interest rates, but the interest rates are coming down despite him.
President Donald Trump on the appointment of a new Fed chair. Some messages we've heard a few times, perhaps. Let's widen the conversation. We have lots of central banks in focus this week, not the Fed, but others around the world. Joining us now, our executive editor for Asia Markets, Paul Dobson, is with us. Let's talk about the markets, Paul, in 3 minutes. Good morning from London. Let's focus in on this busy roster of central banks, data. What do you think has the power to surprise, Paul? Where are we going to see some volatility being created?
Yeah, hi there, Anna. Well, so lots of potential volatility in the FX and rate space this week. It all spins around or off of the Fed, of course. The Fed cutting last week, but then sort of signaling that it might be going on hold for a little bit of time. So that gives the market a time to calibrate where other central banks are going relative to the Fed. The Bank of England is coming along. The market is expecting a cut, although a close vote. And what we get in terms of the readout on how many more cuts there will be will give us close indication of where to trade sterling and gilts as well. That'll be quite interesting. And then we have the ECB the same day, likely to raise its forecasts and stay on hold, maybe, you know, pointing towards a hike at some point in the future. So euro sterling also could look interesting on that metric. Then we get to, for Asia, the big one on Friday, the Bank of Japan. Everybody expects them to hike and to signal that more hikes will be coming as well. That hasn't been helping the yen so far, so maybe finally it will get a little bit of support if the BOJ can sound hawkish enough to convince people that the rates gap between Japan and the Fed is going to start to narrow a little bit more. So that's, I think, where we'll be focusing on and looking forwards to it at the end of the week.
OK, so a busy week for central banks ahead, Paul. But last week, at the end of it at least, seemed to be more dominated by the AI jitters than the Fed cut. I wonder what you see for stocks towards the end of the year. Lots hoping for a Santa rally. Are we going to see a great rotation?
Yeah, I think that's a really interesting one as well. On Friday, you certainly got a sense of that. And through the back end of last week in the US markets, this idea that people are pairing their Fed bets, pairing their tech bets that have been doing so well. Those worries about the build out, the pace and whether it's sustainable, the cost and whether they can fund it as well. And people thinking, well, why not let's spread our chips a little bit wider across the surface. So banks, for example, have been faring well, and other stocks that are more kind of offering more value at these rates. So I think that, you know, at least into year end, the market's going to continue to toy with that theme. But I don't think that the tech story is dead by any means yet. The AI boom still has a lot of potential, and people will find more reasons to get excited about that into the new year.
So that's the busyness of the week ahead. We've already had some data, though, China data. We were just talking to a guest about that, Paul. What was your takeaway?
Yeah, well, pretty gloomy, and the market's taken a little bit of a knock there. We've also got some negative sentiment in the property space, of course, coming from Vanke, the latest of the developers to come under some fiscal duress there as well, struggling with its debts. So there's still clouds hanging over the economy. The market doesn't seem to mind all that much, though. Chinese equities have still been performing well on these growth stories, on China's tech story, as it happens, in the AI space there as well. So people are looking a little bit more optimistically and favorably towards the Chinese market, despite these clouds, and hoping that in the new year we'll get more stimulus as well.
OK, so already some movement in Chinese equities. Bloomberg's Paul Dobson, we thank you so much. And now let's take a look at which stocks to watch in European markets with Chloe Melly. Chloe.
Good morning, Lizzy. Let's start with the car makers today, as the EU is expected to relax some rules around combustion engine vehicles. So this could essentially allow some of those car makers that we have got up here on the screen to transition, to take a little bit more time to transition to emission-free vehicles. And that could be a big relief for those companies. This is the result of some major lobbying from some of those car makers, as well as some countries where the car making industry is really important. And for example, in Germany, the Chancellor has said that this is really about striking a balance between staying competitive within that car making industry and protecting the environment as well. Moving on to another, excuse me, to another industry that's really important to Germany, and that is defense. And Zelensky has hinted that Ukraine could get security guarantees from the US and Europe, and that could replace potentially the long-term goal of joining NATO. So that could potentially lead to some weakness in those defense names today. Usually when there is cautious optimism around those progress, those peace talks, that leads to some weakness in those defense names. So we'll keep an eye on that today. And finally, going over to vapes and cigarettes, the sales of vapes and cigarettes have fallen more than any other category in the UK, and that is because of tighter regulations and, of course, growing health concerns as well. That is according to data from Nielsen IQ. And so we could see that reflected in some weakness in Imperial Brands and BAT this morning, which are the two big and listed tobacco companies that we have got in Europe, in the UK. They've actually been doing pretty well, but this new data could potentially feed through into a bit of weakness this morning.
Chloe, thank you. Our equities reporter, Chloe Melly, getting us started for the week with our stocks to watch. Just a few minutes then until we start equity trading here in Europe. Another stock, Lizzy, that just caught my eye, Argenx, the biotech business based in the Netherlands, Belgium. They have stopped a particular trial over one of their eye disease treatments, and so that could be an area of weakness. It's a fairly substantially market-capped business, actually, so we'll watch that one at the start of trade. But more broadly, the week ahead is about central banks and it's about data and whether we can take anything material away from some of the US data.
Yeah, and of course the jobs data really the focus, more so than the inflation data, I suppose. But we've got futures stateside pointing higher, as they are here in Europe as we head towards the cash open. Euro Stoxx 50 futures up 0.4%, FTSE futures up 0.5%. The Paris session looked to be the underperformer, but we shall see at the open. The opening trade coming up next. This is Bloomberg.
Welcome back, everybody. A few minutes to go until we get the first trading day of the week, heading towards the end of 2025, of course. But we are not done. Plenty of data and central bank decisions due this week. Let's remind ourselves of Friday's session, sometimes useful in terms of how we open up here in Europe. This part of the Friday US session we experienced here in Europe, and we closed out just as the US was in this sort of downward trajectory and downward move. And so that goes some way to explain why we have a bit of a bounce on this morning. So Europe closed where this yellow line is during the US session. The US went on to make some modest gains back from those earlier lows, even if they did close in negative territory substantially. So we have some bouncing to do at the start of our trading day, it would seem, to reflect that latter part of the US session. So we're up on European futures by 0.4% this morning, hoping to make a few gains then, Lizzy. But we do have plenty of data points and central bank decisions still to come, so that could keep us on our toes. And we've already heard some data from China.
We have indeed. Factory output not that weak, but retail sales their worst outside of COVID. So a lopsided economy in China, and that already affecting iron ore and other commodities this morning. So we keep an eye on the miners, especially in London. And then we also have an eye on the autos. Bit of relief perhaps to the likes of Stellantis and Mercedes. The EU, as we report, preparing to soften rules that would have effectively banned new combustion engine vehicles from 2035. So watch those two. And finally, defence, because, of course, we have got Ukraine and the US due to hold the second day of talks in Berlin on a peace plan aimed at ending Russia's invasion. So do watch the likes of Renk, Hensoldt, Rheinmetall and Leonardo at the open, Anna.
Yeah, we'll certainly keep those in focus with geopolitics and gradual movements towards some kind of peace deal in mind. So the start of the European equity market session then for this Monday morning nearly upon us, waiting to see some modest gains coming through across European equities. Will we see some negativity around the basic resources because of the China story, or is that all about retail and therefore not so much about China, about basic resources? Let's have a look and see if we get that coming through in London. The FTSE 100 for the moment up by 0.2%. The Stoxx 600 up by 0.1% then. So we are seeing these modest gains, as suggested by the futures picture, coming through for European equity markets this morning, and just waiting for others to open up. There we go. The IBEX in particular up by 0.8%. 0.2% over in Spain. The CAC 40 up by 0.2%. So that's the big overall mood of the markets, I suppose. A little bit of catch-up for Friday, a little bit of positivity, Lizzy. What else do we see beneath the hood?
Yes, so if we look at the sectoral breakdown on it, we only have two sectors in negative territory this morning, and that's technology and healthcare. But at the top of the basket, we have energy up more than 1%, banks in second place up 0.9%, and basic resources up 0.9%. We were flagging the China story, but indeed basic resources actually in the green. Chloe Melly had told us to watch defence because, of course, we are monitoring the geopolitical situation with Ukraine. We have Rheinmetall down 1.2%, Leonardo down 1.5%, but other names in this sector actually managing to eke out gains. So Safran and Airbus are in the green.
OK, so that's the defence story. And it is interesting to think about what link there might be between the defence names and any peace in Ukraine, because not as simple as a peace deal means no need to spend on defence, because obviously we know the national security plans out of the United States came as quite a shock, even if the messaging has been to somewhat consistent over recent months. There's still going to be a need for a lot of defence spending in Europe, so we'll keep that in mind as well. Back to the markets, and most sectors are actually in positive territory, aren't they? So in keeping with that overall move in equity markets, in indexes, we are higher across nearly every sector. As you say, healthcare is the only one that's negative, and I wonder if Argenx is one of the reasons for that. Yes, that particular biotech down by 7% on the back of one of the results that they posted to the markets, and energy and banks, the best performing sectors this morning. Yeah,
not perhaps as much relief for automakers as we had expected. We were talking about the softening of rules that would have banned new combustion engine vehicles from 2035. You are looking at Mercedes shares up 0.9%, Stellantis up 1.2%, but few lesser gains for the likes of Volkswagen and Renault this morning. Should we dive into the broader themes of this market? John Bilton, head of global multi-asset strategy at JP Morgan Asset Management, joins us round the desk. Welcome, John. I want to start with AI, because we've had some gloomy narrative at the end of last week, lots of jitters around Broadcom and Oracle. You don't think that we need to be that jittery? Why?
No, I don't really, because at the end of the day, we're going out of our way to try and count out what is, we consider, the fourth major technology revolution that we've seen in our lifetimes. I mean, we had the mainframe era back in the 80s, we had the dot-com era, 90s and 2000s, mobile telephony during the early part of the 10s, and of course, this is the next big deal in our view. Huge amounts of investment going in, people trying to call the top in this, but remember, they're comparing it with the dot-com era. These are profitable companies. It has a huge footprint in terms of how it can be supported for the economy broadly. And if you look at capex ratios, we're at about 20-25%, which is way below where we were at the dot-com era. It was about 35%. So, you know, there's a lot of investment going in, and we're beginning to see some signs of this productivity lift. So
you're not worried about the bubble bursting. Do you buy dips? And if so, how big does a dip have to be to buy them?
Well, I think there's a couple of things going on right now. If you actually look at the year as a whole, you know, we're right in the middle of December. You know, people are probably squaring books, thinking about taking some money off the table. What's their big winners been, especially since April? It's been tech. You know, no one got fired for taking profits. Let's be clear here. And if we look at what a 60-40 portfolio's done, 17% if you stayed the course this year. So, you know, squaring books a little bit makes some sense. So, you know, are we expecting a major dip down in tech? No, not really, because the earnings continue to accrue, the investments continue to be made, and a lot of the 2026 revenue is already basically booked because of the investment going in. So we think that there will be buyers not too far down. There's a lot of investment going on, to be clear, but the talk of the bubble might be slightly premature.
OK. Good morning to you, John.
Good morning.
Let me ask about Europe, then, either on that note or thinking more widely. So either because you like tech and you like something that Europe's doing on tech, or because of other things. You become more constructive on Europe. And I wonder what's going into that. Is it that all fiscal stimulus, or is there something else?
So everyone's very clear on the fiscal stimulus. I mean, Germany have been talking about it now since February time. So, you know, that's, to our mind, probably largely discounted. I think what folks have neglected is just how unhappy with the world the European consumer's been. Look at the savings rate, household savings rates, about 15.3, 15.4%. That's the highest it's been outside of COVID. Yet we've got record unemployment across the Eurozone. Record employment, across the Eurozone. So the result is what's going on? And I think we've come off the back of quite a lot of negative news in Europe. We've seen a slowdown in terms of the economy in Germany. Generally, we've had a lot of political news as well. We only need the consumer to begin to move sideways, stop adding to that savings rate, and we begin to get an uplift. And then look, of course, at where the PMIs are pointing. PMIs at the moment are running roughly in line with what would be a 1.6% GDP growth rate for next year. That's above trend growth. So we're positive on Europe from its ability to recover naturally, not just from fiscal stimulus.
So where does that shine a light on European stocks then? Is it about European retailers? Is it about a wider suite of products than just that? Where's the focus?
So there's a few things going on. So right now, our big emphasis is on the euro. Because, of course, we've got the Fed still cutting, we've got the ECB likely on hold, generally supportive of the euro, which is still undervalued in our view, probably by the tune of 7 to 10%. In terms of the stock market, the banking sector's had a great year this year, but we continue to see an uplift, not only in deal activity, but also in the credit impulse. And so generally that's supportive of the banks, who are in decent shape. Outside of that, you know, we've obviously got some sectors which have been very geared to places such as China. You know, data there weak, obviously, as we know, overnight. But generally, we are a little bit more optimistic as we gradually move through the sort of quarters ahead. That potentially supports some of those consumer discretionary names as well, which have not had the greatest of times. So ultimately, when we look at the European index, you know, we're moving away from some of those big defence moves that we saw early in the year and just thinking about the economy gradually sort of, you know, sputtering back into gear.
So if you're positive, not that positive, but positive on Europe, John, does that mean that the ECB's next move's a hike?
So this is an interesting one. So the ECB, you know, if we think where the outlook is for inflation, the ECB have pretty much done what they need to do. We've now got a symmetrical target. We've had that for some time now. You know, we're running at around about the 2% kind of level, give or take change. Do we expect to see a massive early cycle reacceleration in Europe? No. No, this is not a world where we think that you're going to get Europe really sort of going off to the races here. This is talking 1-2 of a percentage point above trend growth, a gradual repair, a broadening out. But let's make no mistake. I mean, there's still a situation in Europe where we've got to deal with certain fiscal issues, you know, places like France, for instance. Germany is only just beginning to see some of the impact of its improving economic outlook, and consumer sentiment remains weak. So I would say we're probably facing an ECB, firmly on hold for the next 6 to 12 months, in our view, at least.
Okay. Yeah. And what's you were keen to talk China a moment ago, and that puts me in mind of the China link with the ECB, the deflationary risk, I suppose, that there is for many places outside the United States from all of those Chinese exports that previously would have gone to the US now going elsewhere. I mean, how significant, how material is that going to be in 2026, do you think?
Well, I think it informs Chinese policymaking. That's the issue here. So if you've got a country which has been used to exporting. Actually, interestingly enough, in the data overnight, the export data wasn't actually too bad. So generally that's holding up, even though it's domestic issues that are the problem. So the question mark is, if you've got a country which has potentially a disinflationary impulse and some overhang in terms of excess capacity, and this is a country with an ageing population, of course, what do? Do you go in and build masses of infrastructure? Probably not. Do you think more about the regulatory stimulus, supporting profitability of companies, some of the work they're doing around anti-involution, etc.? And then, of course, the People's Bank of China, what do they do with rates? So we think that there will be a target for around 5% growth next year, and we think that that will likely require some further easing of policy. So potentially, a relatively easy outlook for rates in China over the next 12 months.
OK, so same target, but maybe a bit more policy needed to get there.
Indeed.
Just coming back to the US, though, because you started by saying how optimistic you are about AI. If we take it to the macro level, since you're relatively optimistic about the US economy, what justifies more cuts from the Fed other than the politics when you look at the economic case? Or should we be talking about Fed hikes?
Well, again, I think, look, monetary policy it's not a sort of spring that goes backwards and forwards. Policymakers like nothing more, in my humble opinion, than to be quite predictable and fairly boring, because that's what keeps economies going on. If they've got some stability and some certainty. So the idea that the Fed overcut and then suddenly overhike, that's really not the look they want to have. So we think there's maybe one more cut to go. And in our view, this wasn't the Fed suddenly responding to the need to massively cut rates much more than they'd previously planned to, they've brought them forward. So effectively, we didn't see the massive spike in inflation that some were concerned about at the end of this year. Inflation, it's above target, but we think that there's scope for it to gradually ease next year. The labour market's been a bit soggy, and that, I think, has given the Fed the ability to just do things sooner. We think maybe one more cut as we come into the first half of next year, and then probably data dependency. And what we're looking at in terms of growth, actually, from our point of view, is real terms growth. So we've got gradual pickup in investment, we've got a pickup in productivity that we're gradually beginning to see. That tends to be something that policymakers like to have on the books, as opposed to something which is being purely driven by nominal growth.
And John, so you think, are we already seeing, I think Chair Powell nodded towards this in the press conference, he thought we are already seeing some productivity gains from AI.
Yes.
Are we at the foothills of that, or do we have to wait a few years to really see what this can deliver?
Well, this is a multi-year phenomenon, let's make no mistake. Right now, we've got the big tech firms, the hyperscalers, who are really capturing the rewards of this. But bear in mind, the investment that's being made, that's something which will accrue to the wider economy. Go back to the mainframe era. It's some of the big tech names in the late 70s, early 80s, were the biggest names in the index. But actually what powered the economy during the 80s was really reaping that return on investment. You're starting to use the mainframes as part of normal business practice. What's super interesting is that so far, in terms of AI, you've now got 40% of the world's population using AI day to day. That's taken 2 years. In the mainframe era, it took 13 years to do that. In the dot-com era, it took about 6 years before 40% of adults were using it. See where we're going? This is accelerating. It's a big deal for the wider economy, and that's why we believe that the productivity upside is definitely there to be played for.
John, can I just finally ask you why you prefer gilts over bunts and treasuries? You're a rare specimen to do this. And I've just been looking at the bookies. They think that Starmer is going to be out of office next year. What's making you so confident that this Labour government can fulfil that fiscal consolidation that they've backloaded?
Well, I think there's a couple of things going on. I mean, first and foremost, you look at fair value on gilts relative to where we are in the UK from an inflation point of view, which is cooling gradually, and also a real growth point of view. Actually, we're a little bit... we're trading a little bit cheap relative to where those things should be. We see a sort of low 4s percentage point level for the 10-year gilt. Turn around to Germany, and actually we know there's more issuance coming, there's a lot of spending about to take place, and generally Europe is reaccelerating. The growth picture here in the UK is a little bit sluggish, a little bit soggy. So I think when we actually look at fair values, it's a question of right-sizing it necessarily, rather than making some big call on fiscal consolidation.
OK, John, thank you very much. Thanks for being with us. John Bilton, Head of Global Multi-Asset Strategy at JP Morgan Asset Management. A quick look at the core six, then, as we wait to get a deeper dive into some of the stock moves this morning. Novo Nordisk on the back foot, down by just shy of 2%. In fact, some drug makers, biotechs in focus today. Rheinmetall in the defence space, that's in keeping with the rest of the sector. It is a negative day for defence names as we continue to watch those meetings ongoing between Ukraine, and today it's going to be European leaders. LVMH moves higher, ASML a little bit of a retreat. We have Schneider Electric up by 1.4%. Let's get a deeper dive into some of the individual names, though, in focus. Chloe Melly has that for us. Chloe.
Good morning, Anna. We are seeing some modest gains for car makers in Europe this morning after the EU is expected to relax, soften some of the rules around combustion engine vehicles. And so that would allow those companies here on the screen a little bit more time to transition to emission-free vehicles. So that's a big relief. And we are seeing some of those companies are moving higher today. As I said, quite modest gains, nothing major, but there's a little bit of relief going on there based on this. Moving on to defence, and we are seeing some weakness here as we monitor the progress of those peace talks that are now entering a second day. So the Ukraine President Zelensky has said, hinted that Ukraine could get some security guarantees from the US and Europe, and that could replace the long-term plan of joining NATO. And so this is signaling that there is progress on those peace talks. And as usual, when we get that optimism around peace talks, we are seeing some downward movements across that defense sector, and we are seeing Rheinmetall in particular down 1.8% this morning on the back of this. Moving on to Argenx, which is a biotech company that has discontinued studies for its flagship drug for thyroid eye disease, and it is down very majorly this morning, more than 8%, almost 9% this morning on the back of that setback that now is really interrupting a really impressive rally for that biotech company. And finally, miners are up this morning as metals prices are rising. Copper is rising because investors are expecting a tighter market next year, and gold is rising as investors are moving towards that safe haven and moving away from technology stocks because of fears around AI and spending. And therefore we are seeing in particular Fresnillo, the gold miner, up at 2.75% this morning, as well as Antofagasta and Glencore also clinching some gains as well on the back of those metals prices rising.
OK, Chloe Melly from our equities team, we thank you so much. And we're going to dive into those themes Chloe was discussing, Ukraine and autos next. This is Bloomberg.
Welcome back to the opening trade. We are 19 minutes into Europe's session, and we've got European equity markets actually on the front foot, up by around 0.4%. A little bit of a rebound from some of the losses that we saw in Europe and in the United States on Friday. A lot of that was focused on the AI-related sell-off, but we do see Europe finding some space to rebound a little bit this morning. US futures pointing a touch higher, but only by 0.2% on E-minis, 1/10 on Nasdaq futures, and so not getting a sense that we're rebounding or recouping all of the losses of Friday, but certainly a little bit of a move higher. Let's talk about the autos sector here in Europe, because Europe's embattled automakers are set to get a breather as they struggle with the transition to emission-free driving, a critical moment that will shape the future of the continent's transport sector. Let's bring in Bloomberg's Elizabeth Behrman, who's been following the story. And we've had a deadline for the end of sales of new combustion engine cars for some time, Elizabeth. But is that being rethought? What are we expecting to hear this week?
We understand that the people talking about taking this effective ban off the table remain locked in talks. We're set to hear more about their decisions and plans tomorrow. It's fair to say that the industry is probably waiting with bated breath as to the exact details of what will be outlined there. We saw the shares of the respective car makers rising slightly, Volkswagen and Stellantis among them. The price reaction is fairly cautious, which would indicate that everybody is also worrying about the devil that usually resides in the details. But overall, I think we can be sure that this effective ban of combustion engine sales will be off the table for the deadline by 2035.
Yeah, Stellantis doing much better than, for example, Mercedes. Stellantis at 1.3%, Mercedes up 0.2%. Elizabeth, just talk us through really what's at stake here.
I think quite a few politicians have been on the front foot explaining that. And Europe is home to a large and very important and a massive job centre in terms of an automotive industry. And the bad news from the industry really has been piling up in the past few months. We've had a headline number from Bosch, the world's biggest supplier of auto components, shedding 13,000 jobs in their automotive unit as a result of a slower shift to EVs than expected. And that picture really is repeated elsewhere across the sector. The most pain for now is among the suppliers, especially in Germany. We've had mounting statistics of companies going out of business, closing plants, and that's obviously a big worry. On the other side of the spectrum, it's fair to say that if you slow down in the EV transition too much, you really risk remaining in a holding pattern while other companies, namely from China, are overtaking us in the technology transformation, because one thing is clear, that we are going to move away from the combustion engine, and losing too much time in that race is going to be just basically postpone the pain for later on.
OK, Bloomberg's Elizabeth Berman out of Munich. We thank you so much for that look at the autos sector this morning. We are seeing it really in the middle of the basket, up 0.5%. But it's a miserable day for the defence names. The moves coming after the Ukrainian President Volodymyr Zelensky signalled that Kyiv could accept security guarantees from the US and Europe in place of its long-term goal of joining NATO. So the likes of Rheinmetall down about 2%. As things stand. Joining us for more is Bloomberg's Oliver Crook, our chief Europe correspondent. Morning, Ollie. Just walk us through the latest comments from Volodymyr Zelensky.
So those comments, they follow the meetings that were held yesterday in Berlin that were attended by President Zelensky. Friedrich Merz, who was obviously sort of overseeing the meeting, who's hosting it there in Berlin, with Jared Kushner and Steve Witkoff. And it was a sort of encouraging sign that the U.S. delegation showed up at all, because on Friday and last week, Trump administration, Donald Trump himself, said that basically he wasn't sure he was going to send any envoys to those meetings. He would only send them if he felt that meaningful progress could be made in the negotiations in trying to achieve a peace plan between Russia and Ukraine. He did, in fact, send his delegation. They spent 5 hours speaking with Zelensky. According to the White House and the U.S. side of things, that a lot of progress was made. And one of the things that Zelensky's put on the table is basically withdrawing, in some sense, his ambition for Ukraine to join NATO. This is seen as sort of giving something up from the Ukrainian side. Obviously, you're surrendering some degree of sovereignty when you agree to not basically freely associate yourself with any kind of particular association. From the Russian side, though, of course, the Ukrainians want an Article 5-like guarantee. The problem is, within this paradox, is the closer you get to an Article 5 guarantee, the more likely the Ukrainians are to sign on to it, and the less likely the Russians are to sign on to it. We should say we haven't heard a great deal from the Russians in terms of reacting to the 20-point plan as it currently stands. We understand it was sent on Wednesday of last week from the European side to the American side, so we don't really know how much traction this has. But again, encouraging that these talks keep going on yesterday and will continue again today in Berlin with a number of other European leaders.
Yes, and let's go there next then, Ollie, because we have other European leaders joining the wider conversations then today. What are we expecting? Who's going to be there, and what are we expecting them to make progress on?
So there are going to be 10 or so European leaders that will be in attendance, including there will also be the Secretary of NATO, Mark Rutte, as well as Ursula von der Leyen attending there, and a sort of the usual cast of suspects, whether it's the President of Finland, Alexander Stubb, Macron, Starmer, Merz, of course, who is hosting the meeting, and a number of other sort of devoted leaders to the Ukrainian cause, all to be discussing. But I think, Anna, really where the sort of importance comes is at the end of the week for these European leaders. We keep taking one step forward with the Russian assets and one step back. On Friday, the emergency powers of the EU were enlisted in order to circumvent Hungary and Slovakia. And over the weekend, we understand that the Italians have now joined a sort of letter suggesting that the European Union should look at alternative ways of funding Ukraine that don't rely on the Russian assets. Now, we should say the Italians are not saying that they're necessarily opposed to this idea, but they are saying that they'd like to hear some other options. Unfortunately for them, I think the only other option that the Europeans have come up with is joint debt. And as we know how sort of contentious an issue that is going to be a very difficult thing to progress across the European Union. So that being said, at the end of this week, we will know finally whether or not the Europeans will make forward progress on that EU loan that will be backed by the Russian assets, 90 billion euros. That is what would fund the Ukrainian war effort and the Ukrainian economy for basically 2/3 of the next 2 years. Whether or not they're going to get it over the line, I have to say, as of Monday, is fairly in doubt.
OK, Ollie, thanks very much. Bloomberg's Oliver Crook joining us there from Brussels. And Oliver's going to have a really busy week. Plenty of guests coming your way from Brussels. Today, we'll be speaking to the European Commissioner for Trade and Economic Security. That's Maroš Šefčovič. Tomorrow, the Commissioner for Enlargement will be with the team. And then finally, on Thursday, we speak to the EU High Representative for Foreign Affairs. That is, of course, Kaja Kallas.
Well, coming up on the programme, a personal appeal to Warner Brothers shareholders as Paramount tries to get the edge in the bidding war. Details next. This is Bloomberg.
Welcome back, everybody. This is the opening trade, 30 minutes into Monday's session, and the picture looks pretty positive across European stocks. Certainly the CAC 40, the FTSE 100, the Spanish market getting some decent gains this morning. A bit of optimism makes a change from Friday, when everyone seemed to be caught once again in a doomy mindset surrounding AI, and certainly that weighed on the US session. We saw that weakness coming through, certainly in the early part of the US session. Then there was a bit of a rebound. We catch up with that a little bit this morning, going a bit higher. Energy stocks, one of the best performing this morning, but broadly, Lizzy, we've got nearly all sectors in positive territory. This is a pretty broad base, small bounce for European stocks this Monday morning.
Yeah, reflecting that green across the screen, across the geographies of Europe, we do have more stock 600 members higher than lower, 411 in the green this morning, Anna. But when it comes to volume, we have said that it is the final full trading week of 2025. And as you might expect, we've got volume lower this morning than usual. Flip the board over and we can take a look at the leaders in the stock 600 this morning. You've got Santander and Schneider Electric up, SAP up 0.9% as well. Flip over and we can look at the laggards as well this morning. And we are looking at Argenx. We'd flag this down 8.2% as things stand. Bad news when it comes to that clinical study, and bad news for Sanofi from the FDA as well. So down 5.2% on that. Novo also in the red. What else we need to know, Anna?
Let's have a look at some of the other stories we're keeping an eye on then this morning. Australia is considering tougher gun laws after 15 people were killed in a terror attack on Bondi Beach. One of the gunmen was also killed. A father and son have been identified as the attackers who targeted members of the Jewish community as they celebrated the start of Hanukkah on Sunday evening. It's the worst terrorist attack in Australia's history. France is seeking to delay this week's EU vote on a free trade agreement with South America. The proposed accord with Mercosur has been 25 years in the making, but the French Prime Minister, Sébastien Lecornu, says measures to protect EU farmers and consumers are so far insufficient. Sources say the deal could collapse if it is not signed by the end of this year. And China's investments slumped further and retail sales expanded at their weakest pace since the crash caused by COVID, in another month of lopsided growth for the country. The Chinese inability to revive consumer spending, or the country's inability to do that, is exposing the economy to risks abroad after it relied on foreign demand to propel growth for much of this year, despite the tariff war unleashed by President Trump. And that Chinese data, really fascinating, Lizzy, just underscoring, I suppose, some of the criticisms that the US and Europe make about China, the imbalanced nature of the economy there, and it doesn't look as if it's moving very quickly towards, trying to rebalance the Chinese economy.
Yeah, factory output not that weak, but retail sales the worst ever outside of the pandemic. That 5% growth target actually looking to be okay for this year. That's what we're hearing from economists, but it's 2026 that is the issue here, and how much fiscal and monetary stimulus are you going to need in order to reach that 5% target, if indeed that's what they choose to set again, when you've got this stress potentially continuing. So the government's saying that it's planning more financial support for consumption, but Xi talking about needing it to not just be superficial, and he wants real growth. So he's thinking long-term and holistically here.
Yes, exactly. And so then we spoke to Phoenix Kalin earlier on, didn't we, with the emerging market beat in mind, and China's such a big part of that, of course, about whether there's going to be a substantial shift in Chinese policy in 2026 then, a slightly different complexion on their GDP targets perhaps, or further stimulus for the retail side of things to try and get a more balanced economy. She didn't seem to be all that hopeful that there would be a sort of major policy rethink in China, just sort of more of the same perhaps coming through there. But just to underscore what you were saying about some of the weakness in the data, the retail sales then, Lizzy, the weakest since COVID, and actually if you take out COVID, this is the weakest since data has been collected on Chinese retail sales. And then fixed asset investment set for the first full year drop since 1998. So that's the extent to which we're seeing those areas of weakness. And yes, industrial output holding up okay because of the ability to find new export markets, but that still raises worrying questions, I suppose, for the rest of the world about deflation, about the extent to which China continues to export that deflation.
Yeah, and indeed we already saw losses in the Chinese session. The CSI 300 down 0.6% earlier. The broader MSCI Pacific Index down about the same amount. But let's go to corporate news. The battle to buy Warner Brothers expected to take months to play out, and to get an edge, David Ellison, the chairman and CEO, of course, of Paramount Skydance, is forcing the firm's board to reconsider his offer by appealing directly to the company's shareholders, some describing it as a hostile bid. Well, we're joined now for analysis by Ben Barringer, Global Head of Technology Research and Investment Strategist at Quilter Cheviot. Really good to have you with us, Ben. We're both dying to talk to you about this exciting corporate drama. But let me start by asking you, why does Netflix want Warner Brothers Discovery? Do you see it as a diversification play, and would it be the end of cinema if it wins?
Look, I think this is a really interesting, opportunistic bid, actually, by Netflix. They've got a really unique opportunity and timing to buy a high-quality asset, both in terms of the content library, but also in terms of the production. So the key asset, of course, is HBO, but you also get the Warner Studios in as well. So I think it's very much about opportunistic. The other thing that's really important, and remember the Netflix business model is all about driving engagement, and obviously HBO and Warner would give them more engagement, and engagement naturally turns into pricing power, and so that's what we've seen. As engagement has grown, Netflix been able to increase its pricing, and along with subscribers, that's led to good revenue growth at Netflix. So I see it as opportunistic from Netflix side.
But of course, who's fighting whom depends on who wins, because Paramount wants to fight Netflix, but Netflix says it wants to fight YouTube. Do you think that actually the US Justice Department will buy that argument that Netflix is using this deal to fight YouTube?
Well, I mean, this is all about regulators' definitions of the market and market power. So Netflix were talking last week, and they were saying that this would take their market share from 8% to 9.2%, and to your point, that's still well below YouTube at sort of 13%. And actually, they were sort of counter arguing to the Paramount offer, and saying that actually Warner Brothers Paramount would take their share up to 13.8%. Right. So I think it's again how the regulators are going to break it down in terms of market definition. Those are the TV market shares. It's slightly different in film.
Yeah, it's really interesting, isn't it? How you define the market. Is it just TV? Is it just TV? Is it film as well? Is it both together? If you're including YouTube, are you starting to think about gaming businesses as well? It's all competition for eyeballs, that kind of thing. But I want to ask you specifically about something I found really interesting in the last couple of weeks, Ben, was when Paramount made their offer, the share price really jumped on the day it made the offer. And sometimes that happens in M&A, but often it doesn't. When you see companies willing to spend large amounts of money, there's risk involved. It doesn't always deliver and create shareholder value. So does that tell us something important about what the market thinks will be created if Paramount gets its hands on Warner Brothers?
Well, that's exactly right. I mean, Warner Brothers and Paramount together create a credible number two, or even potentially, as I say, bigger than Netflix and Disney. And so there is a huge amount of value accretion. The other side of this, though, is that, Sky Paramount needs this deal a lot more than Netflix needs it. You need to be able to merge these two businesses together, one in terms of creating scale, but also in terms of the synergies. And because there's a lot of overlap in the Paramount and Warner Brothers businesses, there's that much more synergy. And so, yes, it's much more imperative that the Sky deal goes through compared to the Netflix one. Yeah.
Yeah. Yeah, I mean, there are many different stakeholders here, and in terms of the wider community in Hollywood, are they pushing back? Are they much more nervous about a Paramount Warner Brothers tie-up because of those quote-unquote synergies, which everybody knows will mean some cost-cutting? Are they much more nervous about that?
I think that's right. Exactly. If you look at the two plans, there's a lot more cost cutting potentially from the Paramount offer. Netflix, although it has exposure in Hollywood, is a lot more diversified geographically. But yes, their offer is still that they're going to create more jobs than they're going to cut in terms of that. But yeah, let's see in terms of the offers which one plays through. Personally, I think it's a bit more of a distraction for Netflix, and they've classically been builders, not buyers. So I think the Paramount deal is structured so that they really do need to win this one.
Ben, what about the stakeholder in the White House? I wonder how much President Trump's vote will be a deciding factor, or whether actually his role's being overblown here. We know that the Ellisons are pro-Trump.
Yeah, so his issue really is around CNN, and it's a little complicated, this, because under the Paramount deal, CNN will be owned by that entity, whereas under the Netflix deal, there'll actually be a spin-out of the CNN and the legacy TV assets. So it's not certain that there'll be a new owner for CNN under the Netflix deal. And so what Trump wants is a new owner for CNN, and so he tends to favour the Paramount deal in some of his commentary. But let's see whether Netflix can work out a way of getting a new owner for CNN, which is ultimately what Trump is interested in. He hasn't opined too much on the sort of regulatory and market definition piece that we were talking about earlier.
And when it comes to CNN, if Paramount's offer's backed by Gulf money, how much of an issue would it be that CNN and CBS News would be part-owned by Gulf monarchies and also, of course, the president's son-in-law? How squeamish would that make Warner?
Well, look, I think, all of this ownership of news media is very difficult for me to opine on. Look, it's not a good look, but, there's plenty of interests in news networks around the world.
Is this going to take months and months, Ben? I mean, it seemed to all happen very quickly, and then we're waiting. Is this going to take months and months, do you think? Are we going to have further offers coming through?
Yeah, I think there will be further offers. I mean, there was a report in the New York Post that that Paramount potentially are going to raise their offer to 33. In terms of the timelines, the Netflix deal would actually take longer, potentially, up to a year, maybe longer, simply because you've got to spin out some of the old legacy TV assets. But even with the Paramount deal, it's going to take, certainly quarters rather than weeks for this to be concluded. So I think we're very much at the early innings rather than the late innings of this game.
OK, Ben, thank you very much. Thanks for joining us. Ben Marriger, Global Head of Technology Research and Investment Strategist at Quilter Cheviot, with that really interesting story. I mean, it does... Someone will have to make a film about this one day, won't they? A movie. It's got movie potential.
Well, it's got TV drama potential. Seasons 1, 2 and 3 just writing themselves for us.
Where are we now, then?
I feel like we're in 2.
OK.
OK. But, yeah, no, let's see who wins out of this. Because so much, political... consequence of this as well. If, as Ben was saying, it ends up being a Paramount deal, and we have to see what happens in the news world as well.
Yes, absolutely. It's interesting how that legacy media, to some degree, not very highly valued and of least interest to the bidders, but it's having an outsized impact on the conversation around what it's worth and where this ends up sitting, this asset. Coming up on the programme, we'll get back to some of the macro agenda this week. The UK is set for a barrage of data and an all-important Bank of England decision this week. We will preview all of that UK action next. This is Bloomberg. Welcome back to the opening trade. 46 minutes into Monday's session, and we have green on the screen across European equity markets. In fact, a little more than maybe we'd anticipated, up by 0.6% over on the Stoxx 600, the wider market. In particular, the more peripheral markets, the FTSE MIB, for example, up by 1%. And US futures actually improving over the last 15 minutes or so. E-minis now up by 0.3%. It is going to be a busy week. We have new US non-farm payrolls, two prints on US non-farm payrolls coming tomorrow. Will either of them shed any light on the jobs situation in the States sufficient to change the debate around the Fed next week? We'll also get some global PMIs. We've got UK CPI on Wednesday, more data coming out from the UK as we go through the week, and a Bank of England rate decision. Then we get US CPI on Thursday and the BOJ, keeping us busy all the way into Friday, Lizzie.
Well, let's focus in on the UK. That widely anticipated rate cut from the Bank of England this week could force policymakers to confront whether the easing cycle is nearing its end, almost 1.5 years after it started. Let's bring in Bloomberg Economics Chief UK economist Dan Hansen for a preview. Dan, it looks like it's going to be on a knife edge.
Yep.
All resting on the governor. They've said that they're moving gradually but not carefully, whatever that means. When do the cuts end, in your view, at this point?
So we think they'll end in the first half of next year. So we think they'll cut this week, data permitting. I think you'll probably need to see some pretty big surprises for them not to cut this week.
Do you have a number in mind of what would stop a cut?
I knew you'd say that. So we think, I think the CPI would have to be a blowout CPI, basically, and that's the one, I think, because if you look at the jobs data, it's the way the data is measured and the like. It's quite difficult for it not to be a 5% handle on the unemployment rate. It's pretty hard for pay growth to not fall, I should say, beneath 4%, just arithmetically the way it works. So I think CPI would be the one that would need to surprise, and particularly measures of underlying inflation that the bank looks at, things like services inflation. As I say, I think the surprise would have to be pretty big, particularly given what's happened in the budget. Given what's happening in the economy, we had a big surprise. Anna and I spoke about it on Friday. We had a big surprise in the GDP numbers. The economy could contract in the final quarter. The bank was expecting 0.3 growth. So that's a massive difference. So all else equal, even if the inflation data is surprising a little bit to the upside, you could dress this up as an insurance cut and send a message that we're not in any rush to cut again, because you are a little bit worried on the other side of other side of things about inflation.
So that's the new thing we do, isn't it? We do insurance cuts if the economy, if there's a sort of stagflation light narrative out there that the economy is weak but inflation is also a bit of a worry. You call it an insurance cut, and then people don't freak out that you ignored entirely the inflation story. Tell us more about that growth story, Dan, because as it settled in, I mean, this is quite a lot of. Usually the 1 month GDP, it doesn't move the needle too much, but it was pretty weak. I mean, there were specifics around one particular car factory, weren't there? But there seemed to always be specifics about why the UK GDP number has come in weak.
Yeah, you're right. There's always, every month we have a one-off and we have a reason why it was weak. But as we were talking on Friday, there were issues in the run-up in that print, things like the budget, the uncertainty around the budget, things about car production. But actually, if you look on an underlying basis, the big story, and Phil Aldrich had a nice story over the weekend about it, is about consumers and about whether consumers will be willing to spend a little bit more going into 2026. Because the story so far has been one of sort of pretty significant caution. And if you have 60% of the economy, which is what consumption is, not spending, it's quite hard to have economic growth. So that's... If you're thinking about the risks, we're maybe talking about an upside inflation surprise, but on the other side, you have moving into 2026 this risk, which is what the governor has said he's more worried about, I should say, which is weak growth driven by weak consumption.
Well, yeah, the split on the MPC seems to be, do you care more about the labour market or inflation, and where is neutral? And no one wants to say except for Alan Taylor. But how weak is the labour market? Like, we've had some private data out this morning. In your view, when you look at things, how weak actually is it?
I think there was a point over the summer where we thought it might be bottoming out in terms of the speed at which the labour market was loosening. I mean, the labour market is operating beneath full employment, so there's slack, as economists call it, in the labour market. I think the latest set of data has sort of poured cold water on that. We've had some continuing of the loosening in the labour market. I think the question is, was that similar to the GDP data, a similar driver, the uncertainty about the budget?
Yeah.
Was it around that? And now firms are going to be, now that we know what was in the budget, because that was what it was about, like what was coming, will the labour market begin to stabilise somewhat? I think the risk with the labour market, and it's always the risk, is that it moves in a non-linear fashion. So you get to, this is why the SARM rule is a thing in the US. You move to a certain level, and all of a sudden the unemployment rate goes very quickly in the wrong direction for a central bank. So that's the risk they want to guard against, and that's the risk, I think, for the Bank of England, is they just don't want to be... They want to be restrictive because of inflation, but they don't want to be too restrictive because of the labour market.
And that non-linearity in mind. Thank you very much, Dan. Good to get your perspective. Bloomberg Economics Chief UK economist Dan Hansen. Probably much more from Dan this week, as we have plenty of UK data and, of course, the Bank of England. Now, for the other major decisions in terms of central banks and the data points, Bloomberg's Valerie Teitel is with us. So we also have, Valerie, the ECB to look ahead to, the BOJ on Friday, and lots of US data. I mean, where do we think the big surprise comes from?
Well, as Dan was mentioning, the weakening of the labour market, I think, is a key focus, not only in the UK, but also in the US, especially after Powell in the press conference last week said out loud that he expects unemployment only to tick up 1 or 2 more tenths in this cycle. So it puts a lot of focus on the unemployment rate. If we do perhaps get an unexpected rise, it's currently at 4.4%, but it has been ticking higher 3 straight months up until the shutdown, and we obviously are not going to get an unemployment rate for the month of the shutdown. But if we do see a decent tick higher, it might start to doubt the Fed's confidence that the labor market is is not, I guess, accelerating its weakness in the U.S. That one is a key focus, but also these central bank decisions, I think, are also, likely to throw maybe a monkey wrench into the market calm this week.
Yeah, unless we paint the ECB as the boring one, actually the forecast could be quite interesting from the ECB.
No, I actually think the ECB could be really interesting because at the same time, it can be very awkward, I think, for Lagarde to answer questions on why have we had all this hawkish language. Meanwhile, in your forecast, you're still undershooting on inflation in 2026 and 2027. The market actually thinks that she could downgrade 2027 core inflation even further from where it is right now at 1.9%. So undershooting on inflation and talking about rate hikes doesn't necessarily add up to the market's minds. Remember, we had the more hawkish side of the governing council, Isabel Schnabel, talk about how she's comfortable with the market pricing in a rate hikes, and that really did upset the bond market in the month of December. Essentially, globally, we've had a sell-off in the belly of these 5-year yields. The market really now starting to doubt any rate hikes or any rate cuts, I guess, for most central banks out there, emerging markets included.
Yeah, I mean, it seems like the market wants to pivot to a new hiking narrative, doesn't it?
Except for the Fed, thankfully. So
right, except for the Fed, although there were questions about that. The media attempting to make that pivot, I suppose, but Jerome Powell pushing back on that. I guess that takes us to the BOJ, where we do have expectations that we get a hike. So I can't work out if they're behind or ahead of the curve, but they're certainly going their own way.
Yeah, so there's been a lot of messaging from Bank of Japan officials of late, almost trying to set up the market for hawkish guidance at this meeting. So let's see how the market actually takes the announcement. But we are expecting a hike from the Bank of Japan. And what we've been led to believe is that they might leave the table open for more hikes next year. The question is, to what extent? Are we talking about 2 or 3 or just one more from the Bank of Japan? We also had reporting overnight that they are looking to begin selling their ETF holdings in January. This is something they signaled back in September. They gave us, the pace at which they wanted to do it, but didn't necessarily declare when they would start selling those into the market. So again, another hawkish angle from the Bank of Japan that they'd be selling these ETF holdings, winding down their balance sheet, essentially, is another thing that they've been trying to do. We've not heard how they're going to be doing that with their bond purchases yet. They've obviously been quiet alongside the huge adjustment to JGB yields we've seen this year.
Well, it was interesting because we were speaking to Sri Kochgovindan earlier, and she was saying actually it's the fiscal story that you need to mind more than the monetary story when it comes to Japan.
That's also very interesting. We have new leadership in Japan, and we know the Bank of Japan isn't always as independent as some think. So we have seen Sanae Takaichi, the new prime minister, almost give permission for the Bank of Japan to be hiking at the moment. She has kind of toned down her language ever since she became prime minister a few months ago. But big questions on her fiscal spend, what kind of bond issuance that entails for a market like JGBs, which you can blame for a lot of the steepening of the curve this year. The long end of the JGB curve has had a humongous readjustment. And the fact is, it might not be over. It might still bleed into 2026.
OK, Valerie, thank you very much. Bloomberg's Valerie Seidel with the latest on what we're watching ahead this week. And Lizzy, I can't work out whether the US data is going to be really exciting and a huge market event because of the flaws in it and the things that aren't there. Will we just end up with a situation where people are able to tell all kinds of stories they want to tell about that US data?
I think we're just happy to finally have a bit of data, even if it isn't complete.
Even
and it's
imperfect.
Not perfect, exactly. But yeah, can we answer that question of whether the Fed's done? Probably not, according to our economists. Anyway, we've got futures pointing higher still stateside. S&P evening up 0.4%, and we're doing well on the stock 600, up 0.6%. That does it for the opening trade. The pulse is up next. This is Bloomberg.